Today, we will talk about how to withdraw from your 401k. Let's have a look at the details. A 401k is a type of retirement savings option offered to many workers through their employers in the United States. Employees with 401k plans are able to deposit a percentage of their paycheck into an account before the money is taxed, and many employers agree to match a portion of the employee's contributions, sometimes up to 100%. Withdrawing from a 401k is not typically allowed until the account holder reaches 59.5 years of age, though some circumstances allow funds to be accessed earlier. First method is withdrawing after age 59.5. Understand 401k withdrawal after age 59.5. At the age of 59.5, you are considered to have reached the minimum distribution age, and can therefore begin withdrawal from your 401k without being subject to a 10% penalty on early distributions. Withdrawals will be taxed at your current income rate due to the fact that your contributions were tax deferred. Tax deferral is when a taxpayer delays payment of taxes to a future period. In theory, net taxes paid should be the same. However, taxes paid after retirement are typically at a lower rate than when working, thus, the tax savings. Taxes can sometimes be deferred indefinitely. Consult a financial advisor to answer any questions. Consulting a financial advisor from the 401k account is a critical step. The intricacies of your retirement account will usually be quite complicated and difficult to negotiate yourself, and therefore expert guidance is often required. Contact your plan administrator to set up a lump sum distribution withdrawal, purchase an annuity, or roll over your 401k. Any withdrawal activity will begin with a discussion with your plan administrator. While your employer sponsors the plan is usually managed by a third-party financial institution, and the plan administrator serves as a connection between you and your plan. Consider setting up a lump sum distribution. The lump sum distribution is a typical form of payout for a 401k. It refers to a payout you can take as taxable income. Plans generally offer a variety of distribution amounts at the option of the account holder, including taking the entire sum at once. Options often include a periodic dollar amount or a fixed percentage of the account on a regular basis. Consider buying an annuity. Buying annuities is a means of receiving an income for the rest of your life, without having to worry about how the source of the income is invested. You can also assign these accounts to your spouse in the event of your death. Consider rolling money into a traditional IRA. An IRA is an account at a financial institution that allows you to save for retirement with tax-free growth or on a tax-deferred basis. A rollover into an IRA refers to the process of moving assets from your 401k into a traditional IRA, where you make fiscal contributions that you deducted on your tax return and where any earnings can potentially grow tax-deferred, until you withdraw them in retirement. This option can allow greater flexibility and control over investments and is recommended by many advisors. Within an IRA, you are free to invest the money as you see fit. Consider rolling money into a Roth IRA. With a Roth IRA, you make contributions with money you've already paid taxes on after tax, and your money may potentially grow tax-free, with tax-free withdrawals in retirement. Consider doing nothing. Doing nothing with your 401k once you reach 59.5 years of age is also a viable option. Providing you are not retiring and are continuing to work, you can continue investing pre-tax funds into your 401k and allowing the principal to grow tax-free, just as you did up until that point. Now, the second method is withdrawing before age 59.5. Understand the consequences of withdrawal. Your 401k is meant to provide retirement income and should be considered a last resort source of cash for expenses before then. Withdrawing from your 401k before you reach retirement age can come with some IRS consequences. Consider alternatives if you need emergency withdrawals. Since withdrawing ahead of time is expensive, it is wise to consider alternative options first if funding is necessary. Withdraw without penalty under Irs Rule 72T. This provision allows you to withdraw money based on your life expectancy. This simply means that the distribution you can receive under this plan is calculated using your estimated life expectancy, which helps to ensure that the distribution you receive will not lead to prematurely depleting your account. Contact your plan administrator. If you plan to withdraw before the age of 59.5 using any of the above methods, your administrator can guide you through the process of bringing funds from your 401k to your bank account. And the third method is making a hardship withdrawal. Determine if you meet the criteria for a hardship withdrawal. In the event of an emergency, some plans allow participants to receive early distributions from a 401k plan, without being subject to the standard 10% early withdrawal penalty in some circumstances. This is known as a hardship withdrawal. It is important to note that taxes will still be due on any early distribution, and it is necessary to prove that the emergency situation is valid. Criteria for qualification include: you or a member of your immediate family has exceptionally high medical expenses. You are buying a principal home. You are paying college tuition for yourself or your family. You need the money to stay out of foreclosure. You need it for the cost of a funeral. If there are necessary home improvements to be made on your principal home. Determine if you qualify for penalty-free withdrawals. In some retirement packages, there are a limited number of specific criteria that allow you to take money out of your 401k without having to pay the 10% penalty. Note that if you do not meet these criteria and are not 59.5 or older, you will be required to pay the penalty. The criteria for exemption include: becoming totally disabled. Are you in debt for medical expenses that exceed 7.5% of your adjusted gross income? Are court ordered to give the money to a divorced spouse, a child, or a dependent? Are fired in the year you turn 55 or later? Prove you need the money due to a hardship. An absolute necessity is a key component of being eligible for this sort of withdrawal. Roll over the funds. Some employers allow non-hardship withdrawals in the form of fund rollovers. This takes money from your 401k and redistributes it to another account, such as an IRA, without a tax penalty. Once the money is rolled over, you might have fewer restrictions for withdrawing due to fewer administrative constraints. Thanks for watching this video. Please don't forget to like and subscribe to our channel if you like our videos.